All right, I think we're right at 10:30, so I'll probably go ahead and get started here. So welcome everyone to this session on reinsurance. Hopefully this is, looks like it's going to be a pretty well-attended session. I'm excited about it. I know reinsurance is definitely a hot topic in many areas right now. So today what I want to do, of course I'll introduce myself first. So my name is Tim Barnett. I work as the P&C Catastrophe Risk Actuary within the Catastrophe Risk Management Center of Excellence at the NAIC. Been at the NAIC for about 5 months now. Before that, I spent about 11 years in the industry. I worked for State Farm, led some catastrophe modeling, catastrophe underwriting, and exposure management teams. Did a lot of work supporting claims, underwriting, pricing, as well as reinsurance, which of course will be our primary topic here today. All right, so I want to start, just share a little bit about our Catastrophe Risk Management Center of Excellence, or the CAT-COE as we call it. We've got Jeff Sikowski, our CIPR director, and the CAT-COE is housed within the CIPR. We've got Ellie Russo, our ERM advisor, that also assists with leading the CAT-COE. And then we've got several members of our team listed here. As you can see, we've got expertise in a number of spaces around modeling, around data, around resiliency, as well as myself, as I mentioned, having an actuarial background and working in the industry as well. So I really want to talk about the motivation for today's session. So why talk about reinsurance? Why are we here today? A couple things that came to mind as I was going through and trying to pull some statistics here. The first being that the majority of U.S. P&C insurance companies are utilizing some form of reinsurance. I tried to find some more specific statistic here and actually had a hard time doing so. But I think you would be hard-pressed to find probably many P&C insurance companies that, again, are not utilizing, whether it's catastrophe reinsurance or some excess liability or some type of quota share. There's so many different types of reinsurance for so many different P&C lines of business. There's reinsurance that's maybe more commonly used by larger companies, smaller companies. So again, most companies are using, again, some sort of reinsurance. And that's evidenced by the statistic I did find here, which is that 20% of total written premiums by U.S. P&C insurance companies are actually being ceded to reinsurance companies. So again, every $5 that are being collected, one of those from the primary market is going to the reinsurance market, which again is a pretty significant volume. Again, it really highlights, I think, the importance and the prevalence of reinsurance in the insurance market. Reinsurance is also important. One of the biggest things is going to be around solvency protection. Catastrophe risk is a very common use for reinsurance. And certainly coming from the CAT-COE is something that I work with pretty frequently. And between 1992 and 2024, I believe there were 85 different insolvencies related to catastrophe risk. In 1992, starting with Hurricane Andrew, and then going up till last year. And the majority, well, not the majority of those, but a significant portion of those, over 20% of those, had occurred just since 2021. So you think about the recent, we've had so many record-breaking hurricane seasons, we've had increased wildfire activity, we've had a lot of severe convective storm focus. A lot of these continue to drive cat-related insolvencies as well. The other thing that I want to talk about, and I'll hit on this later as I go through the presentation as well, is that reinsurance is really, you're going to see how this is tied to the primary market. So how the reinsurance market is going to enable insurance availability. Again, as we think about this in the context of catastrophe risk, if insurance companies want to write on some of these cat-exposed markets and these high-risk markets, they need to be able to find reinsurance. And to the extent that they can, they're able to stay and be present in that market, continue to write. To the extent that they can't, you can either see them withdraw or pause new business writings or other things. And so there's certainly a tie there. The other side of the coin, though, is that the costs that are paid for those companies to get that reinsurance that they so desperately need to continue in that market, it comes with a cost that they're going to pass then onto their policyholders. And so the greater protection you have, the more reinsurance you have, the more costs are going to potentially be passed on down to the policyholders in that state as well. So again, kind of the theme for this, I think the session was titled about how reinsurance is kind of the bridge between the solvency and the rate side of things, is what we're going to see and talk a little bit more about as well. All right, so I want to spend probably a good amount of time, just because I'm not sure of everyone's background, how much you might have been exposed to reinsurance, different types of reinsurance. So the first, about the first half of this is probably going to be about an intro to reinsurance. Then I'll talk a little bit about some of the connection to solvency, more direct, it's easily understood. I'll talk a little bit about the impact that this has on rating and how reinsurance costs can show up in the rating side of things. And then again, we'll kind of end talking about how reinsurance, you'll see how this connects across both of those areas. A lot of times are considered separate, but reinsurance, again, being the kind of that connecting thread across the two, and I'll also touch on resiliency as a solution for that as well. All right, so we'll start with reinsurance fundamentals. So I'm sure everyone in this room at least has familiarity with a basic insurance policy, so I'm not going to spend a lot of time here, obviously, but a very simplified example, to picture the insurance policy is the relationship between the policyholder and the insurance company. Policyholder, of course, is going to pay their insurance premium, and to the extent they have a claim, insurance company is going to pay for that. It's very similar when we're talking about reinsurance. It's a parallel, just the insurance company now is kind of the policyholder. Instead of the actual insurance policy, we have a reinsurance contract in place. The insurance company is going to pay those reinsurance premiums to the reinsurance company. And then to the extent that they have claims that trigger the definition of the contract, the reinsurance company is going to reimburse those for those claims. So putting it together, just looking at these two, again, you can see very clearly the parallels here in a very straightforward way that the reinsurance works. But I do like this graphic here because it helps highlight the two different parts that we're talking about, the rate and the solvency. So as you look at the left-hand side here, you can really see the impact of how reinsurance flows through into the rate. For insurance companies, again, to get this reinsurance coverage, they are paying premiums to the reinsurance company, part of which is going to be funded by the cost of reinsurance that's built into the rates that they're collecting, the premiums they're collecting from their policyholders. And then on the right-hand side, the solvency side, we can see insurance companies, of course, are going to be paying for claims by their policyholders, some of which, if it's a major CAT event, they may only be able to do if they're getting that reimbursement from their reinsurance company as well. So again, I like this kind of simple illustration because, it shows kind of on the left-hand side, like I said, the rate implications as well as the solvency implications at a high level for reinsurance. All right, so let's start talking about some common types of reinsurance. So a lot of times, one of the first things that you talk about when it comes to reinsurance is these two major classes of contracts. You have treaty reinsurance, which is more common and probably what we'll spend most of the time talking about today. Treaty reinsurance is just going to cover an entire class of risk or your entire portfolio. So it might cover all your homeowners policies or all your policies within the state of Texas. Even as you write more, they're going to be covered under this contract because it's defined to cover all of a certain type of business. Facultative, on the other hand, is designed more so for an individual risk. So this might be used in the case where there's one, maybe particularly large commercial specialty risk that otherwise a company wouldn't be interested in writing, so they want to get this facultative reinsurance cover to help limit their losses, specifically just for that one, large, independent, unique structure. So several types of treaty reinsurance. One of these is quota share. Quota share is used by a lot of different companies for a lot of different reasons, and we'll talk about some of the use cases for reinsurance as well as some examples of again, why companies might choose to use this type of reinsurance contract. But it's essentially just a fixed percent of a premium and loss shared. So you can have a 20% quota share, an 80% quota share, a 40% quota share, whatever definition, whatever percentage you would like. And it's as simple as the insurance company shares, again, if it's a 40% quota share, they share 40% of the premiums with the reinsurance company, and then 40% of the losses they experience are going to be paid for by the reinsurance company. So you can think of it almost as just an extension, kind of as the insurance company. They take on a certain portion, again, just defined by that percentage, and share that with the reinsurer. One special type of quota share that's used quite a bit is an 100% quota share. So this is when the risk is completely transferred to the reinsurance company. So the insurance company is maybe just a middle person, if you will. They're the go-between, collecting the premiums and paying out the losses, but all of that is being transferred, at least off their financial books, to the reinsurance company. And we'll talk about a couple of reasons why someone might use a 100% quota share. The other probably big category of reinsurance contracts that we'll talk about today is going to be excess of loss, or sometimes abbreviated as XOL. And this is going to be where a reinsurance company is going to pay for losses above a certain threshold, usually with a limit on it. So a lot of times these are talked about in a way of saying, like 25 million, excess of 25 million, which implies that the first 25 million is something the insurance company will keep. The next 25 after that, or the 25 that's in excess of that first 25, is going to be ceded to the reinsurance company. Like I said, there's typically a limit in terms of how much the reinsurance company will pay. But these can be structured in a couple of different ways. So there's probably two main excess of loss contracts I'll talk about. There is a per risk excess of loss. So this might be used for individual high value risks. So this is a little bit similar to facultative, but again, it's going to be more so for if a company has maybe a risk appetite, they only want to write commercial structures that are less than 5 million in terms of replacement cost. Maybe they structure something per risk treaty to say it's going to be 5 million in excess of 5 million. That kind of extends their ability to write up to $10 million structures while only really still being financially responsible for the first 5 million. But it's generally on an individual risk basis. So I mean, this could be, again, for a single structure, total or partial losses is maybe when this would come into play. On the other hand, you have a catastrophe excess of loss. So this is going to be for a lot of times for your entire portfolio of risks, your accumulation of wildfire or severe convective storm or hurricane or earthquake risk. So to the extent you have a lot of policies in a single area and you have risk of sustaining a major loss, again, you can structure this in a way, you might see like 100 million in excess of 100 million, where again, the insurance company is going to pay the first 100 million of losses from a hurricane, and then for the next 100 million, the reinsurance company is going to come in and pay for that. Anything then beyond that first 200 million goes back to the insurance company being on the hook for that. And I'll walk through, again, some examples of each of these as well. The last type that I'll mention, and at least at one time it was not super common, is stop loss. And this is somewhat similar to excess of loss, and it's somewhat intuitive from how it's named, but it really is intended to limit the insurance company's losses to a specific point. So sometimes this can be tied to a specific loss ratio, for example, and say, hey, we don't want to have a loss ratio greater than 105%. The reinsurance company then, from an unlimited standpoint, is going to pay for any losses that go beyond, again, however that contract is defined. Because it is unlimited, again, these contracts sometimes are more expensive and therefore may not be as common, like I said, at least at one time. All right, so quick overview of the different types of reinsurance contracts. Certainly there are a lot more unique and complex types of transactions, but again, for today, we'll just focus on maybe the things that are most common. Lots of different reasons, though, why reinsurance is going to be needed. So the first point here, enabling policy growth. As we talked about with quota share contracts, this is where this is a lot of times most common. A company that maybe has limited surplus, wants to continue to write, wants to continue to grow, they can enter into a quota share contract, and that will give them some relief on their surplus, on some of their leverage ratio and net written premium to surplus, and enable them to continue to write, and we'll talk through an example of that. But as I mentioned too, if their risk appetite is set at a certain threshold and they want to write above that, per risk, excessive loss contracts might be able to help with that problem as well. Enriching coverage options is another one. Reinsurance companies often are close partners with insurance companies, and so to the extent that an insurer wants to offer a new type of coverage or a new type of endorsement, maybe that they don't have a lot of expertise in terms of how to price, how to actually develop the product, they can partner with a reinsurance company that will maybe does have expertise in that area. And again, I'll talk through an example of that here in just a few minutes. Withdrawing from a market, that is another use case for reinsurance. So, and this is one of the use cases where that 100% quota share might come into play. So if an insurance company is writing in a particular market and maybe they're not profitable, or they've just decided, they've realigned their business strategy and they no longer want to be in that market, rather than having to try to non-renew or cancel or work through these transition plans, they can enter into a 100% quota share reinsurance contract. And so while that book is still present, maybe they decide not to write any new business, but they can kind of have an immediate stop to the financial impact of that on their book, because all the premiums and all the losses for that portion of their book, again, are going to be handled by the reinsurance company. And then as policies attrit through, either being canceled by the policyholder or, any other reason that customers might be shopping, their book slowly decreases over time. But again, they kind of have that immediate stop when they enter into that reinsurance contract. Smoothing loss results is another great example. There's, again, if I talk about some of those, maybe when you think about large commercial structures, these high-value properties or high-value homes, to the extent that you have, a house fire or some sort of theft or vandalism or other types of claims on large properties, it can really distort your overall losses because that one single loss has such a huge impact, maybe on your overall loss ratio. So if you have a type of per risk excess of loss contract, again, maybe that helps to stabilize your loss results a little bit over time, and it smooths out some of the jagged, maybe ups or downs, and some of the volatility you would have otherwise. Last but certainly not least is solvency protection. Again, this is probably one of the most well understood and direct applications of reinsurance, especially in the context of catastrophe risk, but certainly there are other types of solvency risks, as we talk about liability catastrophes and other terrorism type of events. There are a lot of reasons why reinsurance certainly can serve as a protector of solvency as well. All right, so let's talk through an example, starting with ABC Insurance Company. We'll talk about enabling policy growth. So for this company, we'll say they're maybe a relatively new company. They've got about 50 million in surplus. And currently, they've got about 100 million in current and written premium. So their leverage ratio, just 100 divided by 50, currently is 2. Typically, net written premium to surplus should be below 3. And so, now with their leverage ratio of 2, they're in a good spot. But let's say they want to grow quickly. They have a lot of aggressive growth plans, and they want to be able to double their written premium in a matter of just a couple of years. Their current surplus, in theory, would not be able to support that growth because doubling their premium to 200 million divided by their 50 million surplus is going to put them over that threshold of 3. Their leverage ratio is going to be too high. So what are their options here? One option, and hopefully you can see that color okay, but it's a 50% quota share. So here in that graphic, just two boxes side by side, 50% of the premium and loss is going to be retained, 50% of the premium and loss is going to be ceded. And so with that 200 million in current written premium, they're only going to hold on to 100 million of that. 100 million of it is going to be passed on to the reinsurance company. As I mentioned, to the extent they have claims, the reinsurance company is also going to pay half of those. But what does this do to their actual leverage ratio? Well, now their net written premium is only 100 million. And of course, with their 50 million in surplus, their leverage ratio is back to 2, kind of where they started at before they had this growth. So this enables them to be able to continue to more quickly grow. And then as their surplus grows over time, assuming they're profitable, this leverage ratio will start to decrease. And they can change their quota share. Maybe, in a couple of years, they can go down to a 40% quota share or a 20% quota share, and eventually, be able to take on their full book of business and the risk for that. But again, this helps them be able to more quickly grow and establish themselves as a company. All right, let's talk about another example. So you can see I'm real creative here with my fake insurance company names. We've got XYZ Commercial here. Medium-sized company, we'll say they're a more stable carrier. They primarily write small business commercial insurance, multi-peril, so property and liability. Maybe they have an internal risk appetite. They say financially, we can't really support risks that are greater than 25 million. Well, they might have a desire or getting pressure from some of their customers as property values are appreciating, or maybe other customers are coming to their market saying, hey, we want to get insurance from you, but we're above that $25 million threshold. So how can they expand beyond this risk appetite? So again, this is where the per risk excess of loss coverage might be able to come in. So in this example, if they decided to purchase, and again, that light blue color might be hard to see, but it's a 15 million excess of 25 million. So with that layer, what that will do is enable them to write risks that are up to 40 million, only, again, really being financially responsible for the first 25, and being able to cede that 15 away. So it can just help them meet additional customer demands, can help them grow in different types of markets, maybe than they haven't before. And then even to the extent that there's a unique customer that comes along with a $45 million policy, again, they could consider that facultative cover that we talked about earlier for a one-off, really specialty risk to be able to still write that policy as well. All right, another example, this time for a larger company. So we have 123 Mutual here. So they're a large national carrier. They have been established for a long time. They're writing across a lot of different P&C lines. Let's say they want to evolve their homeowners product. They're hearing a lot, probably not surprising in this day and age, about cyber security and cyber liability threat and identity theft kind of evolving all around that. And they want to be able to offer some sort of identity restoration solution as part of the homeowner's policy. But they really have no idea, as would I, with my industry experience, how you would go about pricing or structuring some type of identity restoration product. Well, here, they could decide that they want to partner with a reinsurance company that does have expertise, maybe in this cyber and identity theft space. They could work with them to develop some sort of endorsement to that homeowner's policy that would cover them for identity restoration. This is an example of where you might use 100% quota share. So the reinsurer would be responsible for pricing that coverage. They would collect all the premiums from the insurance company. They would be responsible for all the losses. And so the insurance company then benefits because they don't have to have expertise in this space, and they can broaden the different types of coverage that they can make available to their policyholders without maybe having the financial risk and uncertainty surrounding that type of product that they don't have expertise in. So we've looked now at a couple different ways, for both like a small, a medium, a large insurance company, and some different ways how they might use some of those reinsurance contracts. Before I move on, the only other thing that I want to talk about is just some things in the alternative risk transfer space. So everything we've talked about so far has been traditional reinsurance, which has been used for many years. But recently there have been some innovations, I guess, in the reinsurance space, trying to find different ways that risk can be transferred. And so some of the motivation for this, we talked about catastrophe risk being something that a lot of US P&C insurance companies are exposed to. If you think about how many carriers are out there and trying to seek this coverage to be able to reinsure their catastrophe exposure, the reinsurance market is not going to be unlimited either. There's going to be a point in time where the reinsurers are going to say, we just cannot continue to reinsure additional catastrophe risk. They're trying to diversify their market, and it can't be just a total pass-through, otherwise they'd be in the same exact place that the insurance company is in. So what happens, when essentially you run out of capacity? And that's where cat bonds, as one example of an alternative risk transfer method, really entered into the market. So this was a way, it was designed for additional capital to be brought in from a different source. Instead of in the insurance and reinsurance market, let's tap into the investment market and start to pull in some funds there. So I want to talk through a very, very simplified example for any of those of you who are familiar with cat bonds and how they work. You'll probably realize there are a couple components missing here, but this is really the core way of how a catastrophe bond would be structured and how it would work. So let's say, again, we've got an insurance company. Maybe they've bought some reinsurance. Maybe they would like to be covered up to $125 million. In the reinsurance market, they could really only get coverage up to $100 million. So what they may decide to do is issue a $25 million cat bond, something that's structured, again, above that first $100 million that they're already protected for. It would be that next layer of $25 million. They're going to issue that to investors, and investors are going to say, yeah, we love that because it's not correlated with our stock market and the rest of our portfolio. And so this is a great diversification for our portfolio as well. So we're going to invest $25 million into that bond, which is going to be held for a period of time. Over time, however the contract is defined with their coupon rate and the frequency of those payments, just like a typical bond, they're going to receive payments from that insurance company as a certain percentage of that $25 million that they put in. Now, let's say this is a one-year bond. By the time we get to the end, one or two things will have happened. Either one, if the insurance company experienced, a wildfire, maybe that was $150 million in loss, the investors are going to forfeit that $25 million, and the insurance company can then keep that and use that to pay claims, providing that $25 million of coverage. If the coverage is not triggered at any point, or if it's partially triggered, however much of that principal that's unused, which may be all of it, if the insurance company gets lucky and they have a year with no catastrophes, The investors are then going to receive that $25 million principal back at the end of that bond. Again, very similar to how a traditional bond would work. So you can see hopefully how this helps bring in some additional capital from investors. Again, it's an attractive investment for folks in the investment world because it is a diversifier from a lot of the other risks that they're maybe otherwise exposed to. And then for the insurance company, it also gives them another opportunity to find coverage beyond just the traditional reinsurance market. So there are a lot of different other types of alternative risk transfer. Cat bond is only one of those, but it's one that might show up maybe more frequently in some of the catastrophe reinsurance structures that some of you, potentially as like a financial regulator, could be reviewing. All right, so overview of reinsurance. Hopefully that gives you some understanding. Again, different types, different use cases, some examples of how companies might use it, as well as some things beyond traditional reinsurance as well. So now we're going to move into solvency. Again, this is probably more of a direct use case, but we'll talk through a couple of things actually that the NAIC is doing in this space. So one of the things that we're doing, we're actually working, recently we started working with a couple of states on some different financial exams of insurance companies to really help advise on a couple of specific risk statements that are in the financial examiner handbooks. So under the reinsurance section, there are some risk statements here about insurance companies not establishing or maintaining appropriate reinsurance levels. There's also a risk statement about catastrophe reinsurance protection being inadequate. For underwriting, there's a couple of things related to this as well around, are they managing their cat exposure limits within their risk appetite? And do they have, a reliable process for developing all these cat model results and metrics that are going to underlie and price a lot of the reinsurance contracts as well? So this is some great work that our cat COE team has been involved with as well as the FRS team at the NAIC, and I've bolded the cat reinsurance protections being inadequate because that's an example that I want to step through, again, using fake information, but something that would proxy, a real-world example that you might see and how you can go through and evaluate that structure. So as we talked about, catastrophe risk is a lot of times a significant solvency risk. There's a significant number of risks that an insurance company is going to face. Many of those, significant ones are going to be around investments and market and interest rate and pricing and reserves. But catastrophe risk a lot of times is up there, especially for riders in coastal areas or in the western U.S. with wildfire, and those with a significant property portfolio as well. As I mentioned, we've had a lot of cat-related insolvencies, but really what I want to highlight here are the two bolded statements. So since 1992, about 10% of total P&C insurance company insolvencies have been related to cat events. But really, as we look over the last 3 or 4 years here, it's closer to 60% have been due to catastrophe risk, which again, you can think about the record-breaking hurricane seasons, the focus on SCS and increased losses there, as well as a lot of the wildfire activity in California and also the western U.S. But really, we've even had destructive wildfires in Tennessee and Hawaii and a lot of other states as well. So this really is the driver for, catastrophe reinsurance is going to be of particular importance and interest as you're going through and trying to evaluate, from a financial regulator perspective, if a company is well protected or not. So here we're going to talk through this example of cat reinsurance. I know there's a ton of information on this slide, but we'll kind of just step through it one at a time. So in the top left, we've got this company's surplus. Let's say they have about $750 million in surplus. They've run their catastrophe model. Maybe they're only exposed to hurricane risk, so we've got some hurricane PMLs. If you're not familiar with what a PML is, it's essentially just a metric for looking at and understanding your risk. So an interpretation here, for example, the 1 in 50 PML is going to say on average, about once every 50 years, you're going to expect to have a hurricane that causes about $52 million of loss or greater. Similar for 1 in 100, you can say about once every 100 years, we can expect to have a loss of $142 million or greater. So it just gives you an idea, of all the risks you have in your portfolio combined with the probability of different strengths of hurricanes making landfall and impacting your book of business, what sort of financial exposure am I on the hook for, and how frequently do I expect that to occur? So we've got that at various return periods shown here just to give some context, and you'll see how this plays into how it helps you evaluate this structure as well. So now let's talk about in the bottom left. We've got this structure here. There's a lot of different boxes and a lot of different pieces to this, and hopefully you can see this all right. Typically, the way to interpret a reinsurance structure is to start at the bottom. So here we've got a $25 million retention. So that says the first $25 million of any cat event, whether in this example it would be a hurricane, the insurance company is going to pay out the first $25 million. Now here they've decided maybe to put a cat bond in a lower layer. Maybe not always as common. Cat bonds can show up maybe further up, but in this example here we've got the cat bond sitting at $25 million, excess of $25 million. So again, that second $25 million would be covered by that cat bond. And then above that, we've got three boxes kind of side by side. This is a layer that is $250 million in excess of 50. So it again attaches at that 50 million. Since it provides $250 million of coverage, that gets us all the way up to that $300 million marker on the right-hand side. Now, reinsurance companies, especially for a layer maybe that's this big, are not always going to be willing to take on the entire layer. They may say that's a lot of risk, we don't want to reinsure that entire thing. But I'll give you 40% of that. And so that's what we see in this example here. The two bluish boxes for reinsurer A and reinsurer B maybe have each taken a piece of that pie and say we're going to reinsure 40% of that. Maybe the company said, by the time we've got 80% of that layer filled, we're okay just retaining the rest. So co-participation of 20% is what you see in that green box on the left-hand side. Very similar to what you could think of as just a copay, for insurance. It's just the copay, parallel for reinsurance contracts. And so as you have, your 50 million in first dollar, and every dollar that goes into that layer, 20 cents is going to be paid by the insurance company, and then 40 cents each will come from the two reinsurance companies. So they just kind of share that according to that distribution as losses penetrate that layer. And then at 300 million, you see that's where their reinsurance exhausts or their reinsurance ends. And so anything that happens above that, the original insurance company is going to be back on the hook for as well. So a quick example, if we've got a $160 million hurricane that occurs, you can see here the first $25 million the insurance company is going to pay for. The next $25 million is going to be that forfeited capital from investors from the cat bond that can be used to pay for those claims. And then that leaves $110 million that's going to go into that next layer. And that's exactly going to be split 20%, 40%, 40%, exactly how you would expect across retaining for the original insurance company, as well as the two reinsurers that are paying 40%. So total, the insurance company has the 25 million original and the 22 co-participation, so that's 47 million, I think, that they are retaining from this loss at the end of the day. So again, a significant, $160 million hurricane at the end of the day, they're only on the hook for 47 million, is certainly a very different impact to that company because of this reinsurance structure that's in place. All right, so I've just moved everything. I took the example away, but I moved the surplus, the PMLs, and the structure just over to the left-hand side. And on the right-hand side, what I want to talk through is some different things that you should be thinking about, how you can evaluate the structure to see is, exactly what that risk statement said. Is there any risk that their catastrophe reinsurance protections are inadequate? So the first bullet here, we'll just walk through these kind of one at a time. Cat modeling assumptions. There are a lot of different ways that those PMLs that are shown in that table can be developed. A lot of different assumptions that can be built into that. So something like loss adjustment expenses, the expense that companies have to pay to actually handle those claims, is that built in, to those PMLs? Is that considered as a factor there? Demand surge is another phenomenon that we've seen. You can imagine, especially maybe in a state like Hawaii, where there are maybe limited resources and it's hard to or more expensive to ship materials out. If a lot of customers are impacted in one area and they're all looking for the same services and materials to rebuild their home, that puts upward pressure on the price of all those materials, the labor and materials. And so if you're not reflecting that, in your PMLs and in your overall risk, you might be understating. You might not fully be capturing the real world scenario and costs that you're going to have to pay should an event like that occur. So the next bullet, talking about the retention and the attachment point. So here you can see their reinsurance really attaches at that $25 million. Their retention is that first $25 million. It's always helpful for me to look at that and compare it to their surplus. So 25 million divided by 750 million, and I didn't make this super easy example. I think it's like around 3.5%, maybe 3.3%. So you can see about 3.3% of their surplus is at risk anytime they have a major event. And certainly a little bit more than that too, because they've got that co-participation layer as well that they're going to be on the hook for. And so you might evaluate and say, you know, what is the company's overall risk appetite? Are they comfortable? Do they realize that that much of their surplus is on the hook? What if we have multiple events? If they have 3 hurricanes in a year, you know, that adds up quickly. Maybe now they're down 10% of their surplus. Is that, you know, something that they're comfortable with? Does that align with their risk appetite? Sometimes it's just helpful to ask and see what analysis has been done. You know, how did the company decide the 25 million? If they didn't look at surplus, what did they look at? How did they decide that's how much that they wanted to retain before starting to cede off that risk? Exhaustion point is another important aspect of this. So here their reinsurance stops or exhausts at that $300 million mark. For this, it's helpful for me to look at the hurricane PMLs. And so we can see that is pretty close to the 1 in 250-year PML, which is fairly standard, I would say, for the industry. A lot of companies choose to define their maybe cat risk appetite as saying we want to be protected up to the 1 in 250. Because at the end of the day, you know, they could buy up to the 500, they could buy up to the 1,000. I mean, there's, in theory, 5,000-year PML is 10,000, but you have to draw the line somewhere, right? And this additional cost and the probability of something like that happening becomes more and more remote. So the industry has kind of agreed upon, in part due to rating agencies as well, a lot of times they look at, do you have adequate protection up to your 250-year kind of worst case loss scenario? So again, that's fairly standard, but it still would probably be good to, you know, ask the insurance company how they decided to determine that you know, that's their risk appetite. They want to be protected up to that threshold. The next bullet is co-participation. We talked about that a little bit, but I'll talk about why that's important. Co-participation is not always used. A lot of times companies are able to get layers fully reinsured, even if it takes, you know, 20 or 25 different reinsurance companies. But co-participation can be valuable because it kind of forces an insurance company to continue to have underwriting and pricing discipline on their book of business. You know, if they're fully covered after the first 25 million, they may think, you know, we're going to be a little lax on exactly what policies we're going to write and how much risk we're going to add, because we're kind of off the hook. Now, in the real world, reinsurance companies, again, are going to be very diligent about making sure that their insurance companies are keeping that discipline. But it's something you don't necessarily have to worry about as much if they have, you know, a hand in every loss, every dollar that's getting paid out in that threshold. So having that co-participation can be helpful in just making sure, since the company themselves has a stake in every dollar they pay out, they're certainly going to have a vested interest in making sure that they're following all their procedures and having good underwriting and pricing discipline. So the next topic is reinstatements. This is not something we've talked about yet, but reinstatements are very important in reinsurance structures because it's essentially, it gives you additional cover for multiple events in 1 year. So this structure looks great, but if they don't have any reinstatements and they have, you know, hurricane season is June 1st to November 30th, let's say on June 1st, they get really unfortunate and they have a $300 million hurricane. Well, good news is they had reinsurance in place, so they're only on the hook for, you know, maybe 75 million total between their retention and the co-participation. But beyond that, the rest of hurricane season, they're out of coverage. It's already been paid out. And so they have no additional coverage. A hurricane of any size that occurs next, they're financially responsible for the whole thing. And again, if that happens early on in the hurricane season, that may not be a good you know, position to be in from a solvency perspective. So what reinstatements allow you to do is basically rebuy that coverage again so that it can be in force and you'll be protected from a second or a third event. And a lot of times these can be prepaid. You can pay that when you first enter into the reinsurance contract and agree that it will automatically be reinstated for an additional portion of the premium that you had already paid. Or you might just have the option to reinstate that cover at the original cost should that cover actually be used. So reinstatements, you know, like I said, they're important. Sometimes you have 0, sometimes you have 1, sometimes you have 2. Sometimes it can vary by layer. So here, like the cat bond is probably not going to have a reinstatement. But the big layer, I sure would hope, has at least one prepaid or otherwise reinstatement option to be able to get that cover back. Traditional versus alternative, we talked about this. There's pros and cons to using cat bonds. There's pros and cons to having traditional reinsurance. And I think understanding, again, why a company decided to pursue a cat bond and why they decided that was where they wanted it to be within their structure is helpful in understanding how they think about their risk. And again, knowing that it might not have the same reinstatement opportunities as some of their other layers, again, is going to help you evaluate the effectiveness of this program. Finally, well, two other things. One is going to be around contract provisions. So sometimes reinsurance contracts are structured in such a way that it doesn't provide all the coverage you might expect. Maybe companies are only able to submit claims that happen within a 3-day window for any given hurricane, or maybe a hurricane is defined as something reaching a Category 1. Certainly, if we had a tropical storm, impacting like a very populated area like New York, Long Island, even if that tropical storm is not considered a hurricane, it certainly is going to be very costly for the insurance company. Sometimes loss adjustment expenses cannot be ceded to the reinsurance company through that contract. So just understanding, again, what limitations there are to understand, do they really have the protection that they think they do, that it seems like they do based on the structure here. And then finally, I'd say it's just always helpful to understand, again, as you're talking through and trying to understand how are these reinsurance decisions being made, how are they also being approved? Is there some board committee or board decision or senior executive that is determining and reviewing and approving this structure, just the governance surrounding how that structure gets put into place at the company as well. So as you can see here, this is a lot of different things just from this small information here. Their surplus from the annual financial statements, their PMLs from their RBC filing, and their structure from maybe an ORSA or a reinsurance interrogatory. There's a lot to uncover and pick out of here to better understand and make sure that a company is well protected. All right, so that's everything on the solvency side. We're getting a little short on time, but thankfully these last couple of sections are actually not too bad. We've gotten through the bulk of it. So I want to talk a little bit about reinsurance and rate making, and I'll actually say that some of these slides come directly from a training that you all may be aware of that our CAT COE is putting together. We're holding a training in Biloxi, Mississippi on November 12th, half day, to talk about how CAT models show up in rate filings. And one of the ways that CAT models show up is through the reinsurance provision. And so for those of you who are reviewing rate filings, some of these slides are going to show some examples of rate filings and how the reinsurance provision shows up. And again, something you would see as part of that training as well. So what is the reinsurance provision? It's essentially a way for the company to say, we had to pay, $10 million for this reinsurance, and now we need to try to allocate that down to all of our policyholders so that we can build that into our costs and make sure that, again, we're appropriately covered and able to pay that reinsurance premium. Some of the things that you should see, it's going to be part of the overall indicated premium. It's usually going to be a line item somewhere in there. You're going to see the methodology that they use to develop that. You're going to see what perils they're talking about, how this relates to the perils that are covered by their reinsurance contract. And then you're going to see generally a calculation of this net cost of reinsurance. It's exactly what it sounds like. It's basically just how much did they pay out for the reinsurance, and then what is their expected benefit. You do the subtraction between those two and you kind of get their net cost. The net cost is always positive because, again, they're paying a premium to the reinsurance company who has to make a profit to be able to take on that additional risk. So the net cost, the premium is always going to be greater than that expected benefit. What you might see, a lot of times companies rely on a reinsurance broker, not just to place and structure their reinsurance, but a lot of times they do some of the modeling exercises as well. They might do some of the calculations to determine what is the expected benefit, because that can be kind of a detailed and complex process to calculate. And then a lot of times, again, CAT models are going to be used somewhere in here to determine, to price out the reinsurance contract, as well as to determine that expected benefit. All right, so an example here from a real rate filing. The company name has been removed, but this was a homeowner's rate filing in the state of Mississippi. A lot of text here, a lot of it we don't need to pay attention to, but a couple of blue boxes that I pointed out, just an example of how these things show up in a rate filing. So you're going to see here, they reference the net cost of reinsurance. They say this is the premium it took to acquire our coverage, plus any reinstatement premiums, and then subtracting out the expected amount that we're going to get back from that reinsurance company. So again, that same formula and methodology. You see here they reference, we're relying on an analysis that our reinsurance broker did. Very common, something that you would see quite a bit. And then down in the bottom box, you're going to see here too that they talk about hurricane and severe convective storm. Those are probably the two primary perils when we're talking about Mississippi, so that seems to align well with what perils they're pricing for and how they've allocated this premium. So the last slide kind of on this pricing example here, this is another example this time from a homeowner's filing in Alabama. Again, all publicly available through SURF, but we've removed the company name here. You can see here they've got their reinsurance premiums. So in this example, they paid about $6.5 million for their reinsurance. Their modeling suggests that they're going to save about $2 million, rounding 1.9, I think it rounds to $2 million, due to their reinsurance contract. So just subtracting those two, 6.5 minus 2, you get 4.5 for their net cost of reinsurance. They're going to relate that to whatever their exposure base is, as you would see in a filing. So in this case, you're using amount of insurance years and develop essentially what is that provision per AIY. So that's going to be built in, along with the other loss costs and elements that go into a rate filing to show here's the additional cost specifically for our reinsurance program. So again, how do you evaluate this? A lot of the same things that we talked about from the reinsurance contracts apply here. So again, depending on how they've modeled their expected recoveries and what the contract actually covers is going to be important. So things like loss adjustment expenses, the perils that are at play here, whether demand surge has been included, all important questions. The other big thing here for pricing is going to be how they've allocated their reinsurance premium. So a lot of times, especially if it's a large national carrier, when they think about their hurricane risk, they're not looking at just one single state. They're looking at maybe the entire Gulf Coast where they write. And that hurricane risk doesn't just come from homeowners, it comes from all their commercial structures as well and other lines of business. But they can't just take that one premium they paid for the reinsurance contract that covers all their states and all their lines of business and allocate that all to homeowners in Alabama, because that's certainly not fair to commercial policies in Alabama or all other types of policies in other neighboring states. So in some way, they have to be able to allocate, how should that premium be allocated down to each state and line of business. Most common way is, again, a catastrophe modeling exercise to understand what's driving their risk, which parts of their portfolio are more likely to cause that reinsurance contract to be triggered. But it's important to just make sure that aligns with what the contract covers and that those costs are appropriately allocated. All right, so we've talked about a reinsurance overview, we talked about solvency, we've talked about rate. I'm going to talk now about just putting it all together. So I've just got 2 slides here, so nearing the end. Prior sections, again, we established reinsurance is critical. It's commonly used by P&C insurance companies. One of the major uses is going to be around catastrophe risk and how that helps ensure that insurance is going to be available in some of those higher risk areas. But we also talked about the flip side of that the cost of that protection is going to flow through into policyholder premiums as well. So at the bottom, the 2 key points here is that to the extent that reinsurance is available, insurance companies can continue to operate in those high-risk markets. So in that way, availability in the reinsurance market directly impacts the primary market. The same thing, the more the insurance company has to pay for reinsurance, even if it's available, if they're paying a lot more, that's more cost that's going to be passed through into the primary market as well. And so reinsurance is going to impact both the availability and affordability side, and again, kind of be that connective tissue between the solvency and rate side. So you're probably thinking resiliency was in the title, and this guy hasn't talked about resiliency, and we've got a minute and a half left to go. So my last slide here is going to be around resiliency. I think we all know that catastrophe risk can be mitigated. There's ways to structure and build structures and properties in such a way that they can better withstand earthquakes or high wind speeds or wildfires using fire-resistant materials, impact-resistant roofing for hail risk. A lot of different programs that are out there that have standards to, again, better ensure properties can withstand these types of events. The benefits are across the board. To me, this is a win-win solution. Policyholders, the purpose of insurance is to make them whole, right? And even if they do that, even if they're impacted by a hurricane, and technically, once they've rebuilt, they've been made whole, certainly that was a significant disruption in their life. There are certain things they may never get back. And so being able to avoid that by having a more resilient home is certainly a positive, as well as just posing less of a risk to their company. They're probably going to see a lower premium along with that. Insurance companies love it too. They're going to have lower losses. More of their homes are going to withstand these types of events. Their cat risk, their accumulations are going to be lower. Their PMLs are going to be lower. They'll have to pay less for reinsurance as well. And then reinsurers love this too because, again, their losses are going to be lower, and the market overall is just more sustainable. It's you know, the loss experience, kind of like we talked about, was going to be more smoothed out. It's more stable. And so really, again, the key point here is that investing in resiliency, specifically in the catastrophe space, is going to positively impact both your solvency and your rate because of that tie through reinsurance to both of those sides of the house, both those sides of the equation. So I had a couple of resources here. I won't necessarily spend a lot of time. Maybe the one other thing I'll highlight is just that we've got some training out there. I alluded to some of this. We've got CAT 101 out there, which has a great introduction to catastrophe modeling, which again, you heard wasn't the focus of this, but certainly underlies a lot of what we talked about. We've got a course more specifically on severe convective storm modeling for that peril. And then you can see a lot that's under development. There's a CAT and climate course. I think the first module was actually recently released for that. I mentioned the CAT models and rate filing training. That's going to debut on November 12th. And then we're also developing kind of a Reinsurance 101. Some of the fundamentals are going to be built into probably a longer course touching on some of the things maybe that we left out today as well to try and give you an understanding of basics of reinsurance as well. All right, and I think, unfortunately, I am out of time, so I won't be able to take any questions for right now, but I will be around for the rest of this week, so certainly reach out if there's any questions that you have. Thank you.